So I'm privileged to be presenting this on behalf of two of my colleagues. This is Roselyne Njino, who is away, and Hilary Mulindi is here. Maybe you can stand. All of us, if not many of us, have received emails from Hilary, and thanks, Hilary, for coordinating our attendance today and the invites that we've had. So we're privileged to bring to us a paper on access to bank finance by MSMEs, size and turnover effects. So I think I do not need to belabor the point on the importance of MSMEs in our economy, particularly in their role in driving economic growth and transformation. We've seen many studies have pointed to the fact that MSMEs represent almost all businesses in Kenya, contributing about a third to our GDP, and of course they remain a critical pillar in economic development, job creation, and poverty reduction. But they continue to face a number of challenges, and of course the challenges at the heart of our conversations is really that is related to access to bank finance. And that remains our concern. And of course, as we look at these challenges, we still recognize that 7 out of every 10 MSMEs continue to report difficulties in accessing formal finance. KIPRA has noted this, and it remains a challenge of policy concern, of market interest, because at the end of the day, for us to cause the desirable transformation in our economies, we need to have MSMEs well facilitated. And the facilitation through finance, we know that finance remains the core and the oil and the engine of our development. 80% again of these MSMEs operate informally, and with informality there is a lot of challenges associated with that in terms of record keeping, in terms of how they face compliance issues. So informality introduces a lot of challenges, particularly where they need to access formal finance. So this remains a concern and continues to hinder and constrain their growth potential, particularly if we continue to anchor on them for the desirable economic transformation that we so wish to have. They face high interest rates and more stringent collateral requirements. This is, of course, interest rates is priced based on risk. And with the informality that they continue to operate under, high interest rates is bound to be what they would face as they approach formal financial institutions for credit. Stringent collateral requirements remains a concern because, again, for their financing arrangements, they would need to back it up with collateral. And of course, the discussions there would come in terms of, do we need movable or immovable collaterals in that space? Over 75% of them do not see their third birthday. And of course, that remains a concern because we starting up institutions that do not last for long, do not see their medium-term strategies executed if they have any. And 75% is a concern. And again, with these statistics, they actually add up to their risk again. So they can only access very short-term financing arrangements because of these facts. And all these have been identified by critical institutions, think tanks like KIPRA, the ministry in charge of MSMEs and enterprise development continues to anchor. I mean, some of these messages remain in our lips and are active, so to say. Interventions have been brought in by both the private sector and government. Like, for instance, the government of Kenya, through the credit information sharing mechanism, was really also anchored on supporting MSMEs' access to finance because of the information asymmetry and the opportunity that credit information sharing mechanisms offered in supporting lenders be able to access appropriately and effectively comprehensively the MSMEs as they seek to access finance. Alternative collateral-based lending, of course, the 2017 movable collateral registry was initiated in Kenya. Still some milestones to be covered yet, if you ask me, in terms of what needs to be done to embrace and scale up the use of the movable collateral registry. The Insolvency Act of 2015 was also looking at the debt recovery and business exit mechanisms. And of course, the reforms around there to really support, also targeting the restructuring of MSMEs and how they do business, how best they can actually come out of financial distress. Access to alternative financing instruments also has become a key issue. Now the Kenya Industry Estates is looking at the opportunities around leasing of facilities, shared infrastructure that they have. Can they be used to actually support MSME growth in the country? Then the digital credit providers have also come in as an option for supporting the financing of MSMEs, and of course the licensing that the central bank has now adopted therein. So in one way or the other, all are targeted at supporting the MSME ecosystem, really with the ultimate goal of allowing them and giving them an opportunity and facilitating them to be able to access form of finance. On the private sector end, we have implemented a program called Inuka program. Inuka in Swahili means elevate, to raise. And our objective at KBA was to look at de-risking MSMEs so that they become attractive to bankers. And the de-risking mechanism that we have adopted is really centered on capacity building. For the last 5 or so years, we've implemented this, but really on the strength and the pillar of capacity building, looking at training them to focus on their business ability to access finance, really compliance with certain statutory measures, looking at targeted interventions, again, based on government priority areas like in the leather, the textiles and the agriculture sector. All this, again, was anchored on training. Training of trainer models, so because of the rollout in the entire country, we look at 47 counties in the country, may not be able to reach all the corners, but we adopted the training TOT to be able to reach the masses, but again on training aspect. So the intervention is on training. There are a number of things that would be necessary to be affected in terms of the interventions, but for us so far we've taken on training, and I'm emphasizing this because we'll be able to relate these messages with the results that we are seeing now and look at what we need to do going forward. Again, we leverage on partnerships with various institutions to be able to deliver some of the programs that we are offering the MSMEs. But all the ultimate goal around this is really to de-risk them and make them attractive to bankers. Now we are even getting into other partnerships to be able to start looking at certain segments of the MSME space, like the gender element, and I think we're partnering with FSD Kenya to be able to look at the gender component in particularly on the women-led MSMEs, so that we drive financial inclusion in that space. So we asked ourselves, because this is a research forum, we have to frame our thinking through the lens of researchers that we now are hosting today and the practitioners in the room. So over time, over the last 5 years, we've been able to train more than 70,000 MSMEs across the 47 counties in the country. And as a result of this, we've been able to enable banks to actually push through 5.8 billion shillings as lending, new loans associated with the intervention through this mechanism to MSMEs across all the sectors of the economy. But there's still a lot of scope, because if you look at 5.8 billion, against a 3.6 trillion shillings loan book in the banking sector is still a drop in the ocean. And it could as well not be even a drop. It is still very low. So there's still a lot of scope for us to really grow lending into the MSME segment. So a report by the central bank in 2023 showed that 73% of MSME loan applications were approved by commercial banks. And of course, it matters now, out of this, how many applications were actually were they? Because there could be 73, but out of how many that we are considering. And of course, this continues to differ from one sector to another. So sectoral perspectives start having a role in terms of influencing the approvals. It matters the sector that an MSME is before they can actually access financing. And we will be seeing some of these dynamics as we go along. So the images there actually just show the distribution of credit across the sectors. You can see the dominance of trade sector. You can see real estate also picking up. But again, to a great extent, sectoral dynamics play a key role in the extension of credit by the banking sector. So for us, as we considered this aspect, we were looking at, is there an opportunity for us to measure the impact of what we have done so far, some of these interventions, in as much as it was limited to only capacity building? We know at the back of our minds that the interventions would need to be diverse, would need to look at several aspects, diverse in nature, to be able to fully and comprehensively de-risk the MSMEs. But so far we've looked at capacity building. Perhaps we need to rethink and look at what other interventions do we need in the market. And at the same time also be able to assess, do we have size dynamics, MSME size dynamic at play? Do we have turnover affecting access to finance? So those two aspects have come up in literature to be very strong aspects, particularly in influencing access to finance. But also at the same time, can we measure the impact of the interventions that we have so far deployed in terms of enabling MSMEs access finance? Of course, we had to anchor our research around some theoretical foundations and underpinnings. Credit rationing theory of Stiglitz and Weiss of 1981, just to emphasize the fact that MSMEs often are denied credit because of the risk perceptions. Perception of risk is important to analyze, is important to assess, because perception in itself can actually spur further perception in terms of the risk, if you were to look at analysis of risk. So because lenders perceive MSMEs as risky, even on coming, emerging lenders will also adopt the same perception. Pecking order theory, in terms of identification of what options do they have. Can they raise financing from internal or from external sources? Financial growth theory, again, look at MSMEs facing credit constraints due to information asymmetry. Lenders do not have full information. Right now, discussions around credit information sharing are also centered around how do we expand beyond credit data to start looking at alternative forms of information that can inform credit scores. So because of information asymmetry, now we're moving away from credit information asymmetry to the overall picture about the full information asymmetry to start onboarding the rest of information that would be critical for on lending to actually trigger further lending to MSMEs. Empirical evidence has shown that factors such as size, profitability, which of course is linked to sales and turnover, have become very critical factors beyond collateral requirements in terms of influencing and unlocking credit to private sector. So despite all these considerations in theory and what has been done elsewhere, we still see that there is a lot of need for us to really understand deeper the impact of interventions that we have so far deployed, but also at the same time be able to analyze size and turnover effects in influencing access to bank finance by MSMEs. And all these are geared at informing our next course of action in terms of next interventions that we need to deploy, the policy action that would need to be taken to support MSME access to finance. I know government now, even on the other end, is also looking at Hustler Fund. And of course, without mentioning too much and too many of the challenges that continues to face the fund, it's an intervention, it's an effort to support MSMEs in the country. But to what extent would they need to borrow from empirical and analytical knowledge for them to design appropriate interventions going forward? So we did a survey at the beginning of this year, really to just be able to attempt to measure the impact of our intervention, and we gathered information from about 886 enterprises across the 47 counties in the country, stratified across county, sector, and gender to ensure that there is adequate representation. So there is fairly good balance across the sectors. But what emerged out of this is that we still see a majority of the MSMEs, because we were pursuing those that are under the program, under the INUCA program, and those that are not under the INUCA program, but we still see the same trends in terms of a majority of them are still micro in nature. That is, those that have up to 10 employees. Of course, many businesses, you can see that in 8 out of every 10 MSMEs, the SMEs will be described as micro, so in nature. So looking at also the turnovers, if you look at the turnover, this is the graph in the middle, it varies considerably from those with less than 100,000 shillings a year. You can imagine 100,000 a year in terms of turnover, to about 100 to 250,000, with a fair distribution in between. And the dynamics there in terms of turnover are very critical. And of course, in banking, definitely the anchor for lending, again, is cash flows. Are you able to generate the necessary cash flows to support repayments for loans? So turnover is something that is dynamic and is uniform, whether you are within the INUCA program or outside the INUCA program. Again, turnover can have a role in influencing dynamics around access to finance. In the facilities that they access, you can see that a majority of the bankers, if you look at the blue bars, which is actually reflecting on the utilization of the different facilities in the banking sector, a majority of them are within the short-term lending of less than 3 months. Again, it reflects on uncertainty associated with the borrower in this case. So are they able to do a lot of scale operations with very short-term financing is a question at hand. So how do we move from them relying heavily on short-term financing towards the longer-term financing? Because if you look at the long-term lending of over 3 months, just about 34% of them are able to access that. And again, that remains a concern. And of course, that's what anchored our interest to be able to pursue the study that we have here. Yeah, this is for the comfort of our the analytical minds in the room. So our interest was really to look at the impact of the program that we have deployed, but we have a modification and a disclaimer here to make that the time dynamic there is not what we know in time series analysis, but ideally we're looking at the time the institution has been in operation and then we actually we separate from 2018 when the INUCA program started to be deployed. So the deployment of the program itself in 2018, plus the institution having been in existence from 2018 to date, is what we capture using the difference in difference estimator of interest here. So the outcome variable is access to bank finance, which is the Y variable. Program is really participation in the INUCA program. Time represents the time when the MSME has been in operation, and we delineate that with before and after 2018. So the X is control of all the other factors that are important in influencing access to finance, and that includes aspects such as age of the enterprise owner, the education level, sector size, and turnover. Now our interest was on size and turnover effect. So we delve into that as we control for all those other factors. The results that we have generated in the difference in difference estimator. So remember that our focus is on the size and turnover effects. We just wanted to assess the impact of the intervention that we did, in which case then would be covered and carried in the difference in different difference coefficient. Yeah, and I must warn you too that only captures the impact of the program for institutions that started within the implementation period for INUCA program. But we still go back to interpret the effect of the program on the program coefficients that we have out there. But initially on the baseline model, where we include both turnover and size, we see that these size effects are definitely evident. Micro institutions are seen to be accessing more financing from the banking sector compared to the small and the medium enterprises. And again, turnover effects. Institutions apparently with turnovers between 250 and 500 seem to be less advantaged compared to those that have turnovers of over $1 million. And of course, this is more evident when we look at amongst the 250 to 500,000 shilling turnover. So we can see evidence from the baseline model, particularly with these preliminary results, that size has an effect, turnover has an effect from the baseline model. So we then went on to say, can we separate and analyze them separately? Because as in the initial presentation, unbundling brings out several intricacies in the data that we may be interested to see, as we saw earlier in the presentation in the morning. So we go into the category for micro enterprises and analyze them. But one thing that is coming out strongly is the sector effects. When we open within the small enterprises category, sector plays a key role, and trade is significantly different from others. Trade sector accesses more financing compared to virtually all other sectors, and that is significant, very strong significance level. But also when we go into a particular segment and size of MSME, now the turnover effects are not very evident in access to finance, and yet in the global model they were actually evident. So meaning in unbundling to a particular group of MSMEs within a particular segment, turnover doesn't matter. It matters where you are, which sector you're operating in for you to access finance, with trade having relatively stronger access when compared to other segments, other sectors of the economy, like agriculture, energy, services, building and construction. But also when we now looked deeper into the turnover effects, emerging results show that we actually the program, the intervention that we deployed through the INUCA program was more evident and more significant for those that had a turnover of between 100 250,000 shillings. Again, which was a positive effect in scaling them to access more credit. So training, but remember at the back of your mind, the program we had is only training. There could be other interventions that are needed. So the coefficients definitely being small and insignificant in some cases is really reflective of the fact that this was only on the training side. But as to whether they were actually able to also take other mitigative actions around this is a concern at the moment. So the sector effects are also evident, and you can actually see that relative, because the reference category for the sector was actually the trade sector. So sector effects are at play in specific turnover levels. So if we look at the 100 to 250,000 turnover category, trade was receiving less and less for the lower turnover level, but other sectors were receiving higher credit limits, which is a concern. But now when you move to higher turnover levels, like between 500 to a million shillings, again we see a reversal, that the other sectors receive less and less. So are there dynamics around trade that lenders would be keen to know, in terms of, at the beginning, lenders shy away, but once they establish themselves in trade and are able to demonstrate cash flows over time, and the cash flow is sizable enough, they are even able to access more financing, as the other sectors access less and less compared to the trade sector. So the analysis so far that we have done is actually pointing us to some evidence of size and turnover effects in access to bank finance, and a deep dive to the size shows that significant sector variations in access to finance are evident, with the trade sector evidently remaining superior or a preferred option for the lenders when you look at this small category, when you look at specific segments. But on the turnover side, we see the impact of the intervention coming out, particularly on particular turnover levels. And of course, our interest was to look at the dynamics again within lending to trade when the turnover is low, and lending to trade when the turnover is high is emerging to be, it's not a straight line. Looks like an inverted curve, so to say. So that trade is receiving less and less when their turnovers are lower, but receiving more compared to other sectors when the turnovers are elevated. Again, bringing us to the point around pecking order. Is there a financing option that is considered by trade when they are at start and when they have started growing? Do they get the confidence to approach a bank when the cash flows are strong enough so that there is internal financing? I know many of the studies that have been done have shown that many MSMEs also are financing their startups through family finance, savings, and things like that, other than formal finance. So, but when they have demonstrated their operations and can demonstrate their cash flow position, they can actually access bank finance. So within categories of turnover, sector matters to a great extent, as trade receives less credit for lower turnovers, but more credit for higher turnovers. So again, those dynamics need to be considered. Again, cash flow issue becomes comes to the center of lending for bankers. So the implications that we see from this, of course, we anchor our study on the size and turnover effects, which are evident. It means then the creation of policies around MSME support programs must put in place and consider the sizes of institutions and the turnover level, so that interventions can be deployed at various levels. If it's at micro, we need to design them differently from those that are small, and the same should be extended to those that are medium. Trade sector is definitely, evidently different from other sectors, and this is seen at different levels of turnover. So it means there are dynamics around starting up in the trade which are different from progressing, and as they grow, things change, perhaps as they demonstrate their positioning and ability to withstand shocks. KBA intervention to support MSMEs access to credit has borne some fruit, but it needs to be augmented beyond capacity building, because capacity building has delivered something for particular segments. We saw that for the smaller turnover level MSMEs, it was able to significantly influence access to credit. Perhaps that can be attributed to the 5.8 billion that we saw. But then, is that enough impact? Perhaps the need to start considering interventions beyond capacity building to be considered for a stronger impact on access to finance should be put into consideration. So ideally, we say that policies to support MSMEs in the country should not be one size fits all, but should consider MSMEs stage of development, and of course with stage of development means size effects and turnover levels, and interventions formulated must also go beyond capacity building to create significant impact in the market. Thank you. That's our presentation. We agreed that all the questions, Hilary, will take note and answer to the best that we can. Otherwise, allow me now to invite, because it's in our practice, we have the paper presentation, then we have a discussant. The discussant for this paper is a non-researcher, is a practicing banker in one of the top banks in the country, is Mr. David Ndwiga from NCBA Bank, and allow me to give him 9 minutes, 5 minutes. And then we open it for Q&A, but in the Q&A you're free to ask questions, give comments on what needs to be considered beyond this. If you have proposals on some additional interventions beyond capacity building, we're also free to take those comments as we onboard your comments in our paper as we finalize it going forward. Thank you.
Thank you so much, Sam. I'll take at least 5 minutes because there are some of the comments that I had on the paper which have been addressed during the presentation, if I compare with what I had the paper that was shared. So a quick scan is that first of all what we get is that the paper is timely, given that MSMEs have under challenge in access to not only credit but formal credit from the formal lending institutions or channels. And first of all is that the paper is cognizant first of all of the importance of MSMEs with regard to economic growth and development. And then the other thing is that the paper is cognizant of the financing challenges that MSMEs have been facing in the context of the Kenyan economy with regard to formal credit access. Again, the paper is also cognizant of several interventions which have been done both by the KBA, the banks themselves, of course, and also central bank, central bank, yes, and also the aspect of national treasury and the government at large. So what we see from this paper is that there's an intervention by KBA come year 2018, which is the INUCA program, towards enhancing access to formal credit by MSMEs. So the paper tries to evaluate the impact of this program on the access of credit, formal credit by MSMEs in Kenya. And it has highlighted a number of progress that has been made since then. We've had a figure of 7,000 SMEs and 3.2 Kenya shilling billion having been dispersed to these SMEs from the formal lending channel. And then what we get is that in highlight, the paper mentions about the issue of the size of the enterprise matters and the turnovers also matters. If you are analyzing the impact of INUCA program on the access of credit by MSMEs from commercial banks. Also, there's some studies that we did some years back about the analyzing of sectoral lending bias by commercial banks. It is also evident in this paper that they find the element of sectoral bias. And the question that I'll be raising later as I go to the areas of improvement will also touch on this. So the following are the areas that are being the discussant I felt could improve the paper more. One, if you read through the paper in figure 1, and that slide has been shared by the presenter, about various interventions that have been done apart from INUCA program to support MSMEs to access formal credit. So what the paper could do is that, for example, it is going to maybe provide an overview of what these interventions have so far achieved, as opposed with regard to enhancing access of SMEs accessing formal credit. For instance, the collateral register, I know it has been fair and a work in progress. What has it unlocked? The other programs by credit information sharing, what have they unlocked? So it is going to offer maybe a one paragraph to maybe a one page discussion in your paper on what they have achieved. The reason is that you will now by doing that, you will have taken cognizance of some of the effects that when you go to your difference in difference analysis, you don't lump all the you don't give credit to INUCA alone as having achieved this. But it is good also to appreciate that in literature and in your motivation of the paper, what those interventions have achieved. Secondly is the element of the sectoral bias. Now it has been confirmed by use of cross-sectional data. The paper looks at several sectors. Trade is one of them, manufacturing, agriculture, energy, building and construction, ICT and services. So this is a bit, when you look at the baseline model, the paper uses trade as the benchmark sector. My question would be, if you look at all those sectors listed, we know agriculture receives substantially a very minimal funding, and that has been the case throughout. My question is, what would the result look like? It's just a deep dive. If you just use agriculture as the benchmark as opposed to trade, because you know that a majority of the SMEs are in trade, whether retail or wholesale trade. And perhaps from that 500, the 886 firms that you covered, SMEs that you covered, perhaps a bigger chunk of them would be in trade. So what would be the change if you change your benchmark categories sector from being trades to agriculture, by the fact that agriculture receives substantially the minimal funding from formal lending channels? The other thing is that when you look at the results when I ran the paper, it seems that the highest entrance in the program, INUCA program, the highest entrance of MSMEs is in the year 2020. And my question is, and then it dwindled down in 2021, 2022, 2023. And my question is, what would have informed this high entrance of MSMEs in INUCA program in the year 2020? And the question is that could COVID-19 be one of the contributory factors? I have worked in an institution also which is an umbrella body, and I know during the year 2020, some of the umbrella body institutions actually crafted their own lending, whereby they were supporting MSMEs by giving them credit of the formal banking channel at a cheaper interest rate. And that is one of the intervention that has been there. And some of them could mobilize funding from some of the DFIs and the development institutions. So what informs in your case why you have the highest entrance in 2020? And from there, 2021, 2022, 2023, we see the number of the firms in the program dwindling down. Perhaps that could also be from the technical side, maybe from the financing that KBA is having around that area. The other thing is that we see majority of the loans are short-term. That is from we end overdraft, and then we have less than 1 month, 1 month, 3 months, and then above 3 months, which you're considering as long-term. And my question is that what is the policy implication do we get from this, whereby it is very clear that banks are channeling formal lending to SMEs only on short-term basis? could we have an element of the risk factor that the banks are not able to factor in lending to these micros and small in the long run? And that would inform, do we need a more of a de-risking or a change of, as Professor was talking about, the lending model, so that the bank is able to capture these risks and give a longer term loan or a longer tenor loan as opposed to 1 to 3. Because the question is, would they, how much substantially are they able to develop by a 3-month credit? If you are to advance more, then it means what is the policy implication, or what would be the reason as to why the tenor is, majority of the tenor is around this range. Then the other thing is that still on the sectoral bias, what does it tell us? Does it imply that banks are still using their traditional model when it comes to selecting the sectors to which you should lend? And here in the morning, we heard the Vice Chair of KBA mentioning about things are changing. And therefore the question is that, is sectoral bias, because it has been there throughout, is it talking to or conforming to banks still sticking in their traditional models when it comes to selecting which sector to lend to? And if that happens, given that the banks are competing for one customer niche, what will happen in terms of competitiveness and also lending and also the demand side? So that is another question that I posed to the paper with regard to the issue of the preference for trade sector. Then on the annual turnover, the paper highlights that the impact of INUCA program seems to be more pronounced, with a positive and significant impact when you look at the turnover of 100,000 to 250,000. But when you move to above 250,000, in fact, between half a million to 1 million, you have a negative effect. And then the question is here that I have is that, what informs this negative effect? And in this negative effect, when it is there, what does it tell us? That why are banks shying off lending to institutions with, or MSMEs with high turnover? And when you look at this lending, it is within 1 month to 3 months, as opposed to looking at the turnovers. And I have an insight here. For my own understanding is the turnover may not imply the ability to service the loan, because the turnover would be on the sales turnover that you're making, but more of an insight here could be maybe banks will be looking at also the cost side, because remember when we mentioned about the issue of revenue and the cost margins, you could be having a high turnover, but your cost margins are high, and therefore your profitability comes down. And could that be also maybe to motivate your level of argument in that area? Because normally a higher turnover may not imply high profitability, or may not imply the higher probability or ability for the MSME to repay the loan. And then, as I finish, there's also the issue of the size of the business matter, with the bias on the micro. And of course here we know that micro is more because medium is used as the benchmark. And the question is that, again, why are the banks more comfortable in lending to micro when it comes to the INUCA program, and lending less to small and medium? And then the question would be, would this medium, because you know there are some medium enterprises who could actually be covered under corporate lending or corporate business. Then the recommendation going forward, because this program started in 2018, I wouldn't recommend KBA to look at it of running it with a sort of a tracker. So you want to look at, and every year you develop a tracker whereby you keep track on the same SMEs, and then you want to find out an SME that was able to access only a loan of 1 to 3 months last year for the survey, as that improved in the next year. Because that would talk about the issue of the journey that MSME moves with a commercial bank, and therefore would tell whether banks are having confidence in dealing with an SME that they have dealt with for a long time, because banking is about the issue of the customer relationship. So there's going to have a tracker. As you earn new MSMEs in your survey, always have the tracker for the ones that you have covered in last year, so that you have a sort of analysis and you're able to tell the trend. Because you might miss the trend by every survey if you do it using different MSMEs. And then lastly is that trade receives more financing. I think this one I mentioned about it, about the issue of sectoral bias. Otherwise, I think with that, I submit my comments, and congratulations to the authors. Thank you.